It is 13F season, which means super investors have to file a report that Dataroma website uses to show what they have been buying and what they have been selling. If you want to know what Dataroma does, I have already made a video around that, so I'm gonna link it up here and you can find the link in the description below too. So here we have the list of all the most bought stocks in the last quarter by super investors, and we are gonna go through the 5 top ones, which is gonna be Intuit, bought by 7 super investors, Microsoft bought by 9, Meta bought by 9, Google bought by 14, Amazon bought by 14. The thing to remember here is we need to look at these companies as some ideas, not just a list of companies to go and buy. This is very important. Don't just buy companies because some super investor has bought it. We need to do our own research and make sure that these are great businesses for us. So without further ado, let's get into it. Hello and welcome. So the first company was Intuit. This is a US-based company that creates software products around finances. So if you live in the US, probably you have declared your taxes using one of their services. Their services is being used mostly by small and medium-sized businesses, but they have services for private customers too. We have their price chart here, and you can see in 2020 and 2021, they went crazy high, but in 2022 they went down, so probably the super investors thought that this is a very good price and they bought a lot here. This company has a very big moat because they have a complete set of software and they almost have no competition in the areas that they work. So let's take a look at their finances. If we go to their revenue breakdown, we can see they have something like maybe 10 billion sales in 2022. And almost half of it was a small business and self-employed people that bought their services. So let's get into their statements and let's take a look at the income statement. So their revenue in the past 6 years has tripled, which is really good sign. It shows that they are increasing their sales every year by at least 10% and sometimes 25, 32%. So that's why it went crazy high in these 2 years. They were able to increase their revenue very fast. And then their gross margin is very good. They don't need to spend that much on the cost of goods sold, but that's expected. They are a software company, but their operation expenses are a little bit high. So let's take a look and see what they are spending on. It seems that most of their expenses are in sales, general and admin expenses, which is probably their salaries. So this is something we need to take a look at later on, maybe, to know if this is something that can get out of hand. But their operating margin is very good. So if they have an operating margin of around 25%, we are happy. And it's almost like 20%. So that's good. Let's go a little bit down and take a look at their shares outstanding. So their share outstanding was going down and then suddenly here it started going up. But these 2 years their stock prices was going up too, so maybe that makes sense to dilute the shareholders a little bit. If people are willing to buy your business at a crazy price, I don't mind getting the cash, but this is important. Why did it go up? Did they give a lot of shares to employees? Did they buy a business using these shares, or did they just sell it to other people? So we need to take a look at that later on. Let's take a look at their balance sheet and see if they have a strong balance sheet. They have a total asset of 29 billion and total liability of 11 billion. Equity is something like 17 billion. What about debt? They have a total debt of 7 billion. That's not too high for their income, so they can pay it in something like 3 years. What about cash flow? So they have a higher cash flow than earning. That is really good. So they have 4 billion and then their debt is 7 billion, so they can easily pay it in 2 years. Let's take a look at their cash position. So they have 4 billion in cash, which is really good. They can pay half of their debt whenever they want. Their net debt is around 3 billion. Their receivable is not that high, so that's good. But let's take a look and see how are we doing with net intangibles. And this is something a little bit worrying. So they have 29 billion of total assets, and then 20 billion of it is in net intangible. That's understandable because they are a software company, so probably many things they spend to build those softwares they put on intangible assets, and over the years they will amortize it. But the goodwill is very high, which is something like 14 billion. This means that they have been buying other businesses a lot, and that can be a little bit worrisome, but we need to do more research on this. By itself, it won't be a bad thing. We need to take a look at it and know what's happening, because this company does not have lots of debt, and they have a good cash flow, and they have a good cash position. They are not in danger in any ways. So let's take a look at their cash flow. So each year they have been growing their cash from operating activities, so something like 4 billion, and they didn't need to invest that much back into the business, which is good. They needed to reinvest something like maybe 6%, which is very good. But they have been buying some other businesses. So this is the thing that we need to take a look to see if the management paid a fair price for those businesses. So this is something we will look on later on. They have been paying dividend too. Dividend is easily covered by their free cash flow and their earnings, so that's good. They have gone into more debt lately, so they have doubled their debt, probably to buy a business. That's why they diluted themselves and got into more debt to buy those businesses that we saw here. They have been paying to retire more stocks, but their number of stocks didn't go down. So this part is a little bit worrisome for someone like me, at least. I want to see share outstanding going down, not going up. They have been buying back their shares, but they have been diluting more than they have bought. So that's a little bit worrisome. But overall, this seems like a good business. They have a good cash flow. They have a good moat. So for now, we are gonna keep it on our watch list, and later on probably do more research on them. So let's move on to the next one, which was Microsoft. So Microsoft, probably everyone knows them. Their main product is Microsoft Windows, Office 365, and they have Bing Search, LinkedIn, and many more services that we probably use every day. So let's go to their finances and let's take a look at their breakdown of their revenue. So they have Microsoft Cloud too, so that's a big part of their revenue, Microsoft Azure. They have productivity and business processes, which is Office 365, and we can see every year their revenue was going up. They have a great moat, so this seems like a great business, but let's take a look at their statement. So we will start from the income statement. We can see they have doubled their revenue in the past 6 years, which is great, and their operating margin is something around 40%, which is great. It shows that they have pricing power, and we love that. And we can see their net income has gone up something like 4 times, which is great. Let's take a look at diluted share outstanding, and it has been going down. So from 8 billion, they have been going down steadily to 7.5, which we love. So let's go and take a look at the cash flow statement. 33 billion cash from operating activities, almost 3 times now, 89 billion, and they have been reinvesting a lot of it. So something like maybe 30% of it they have been reinvesting back into the business, which is expected. They are trying to grow their cloud business, so they are probably buying a lot of servers. And let's take a look at their financing activities. They have been paying a dividend, which is something like maybe 20%, 30% of their free cash flow, which is manageable. That's good. They have been reducing their debt in the past couple of years, and they have been buying back their shares a lot too, which is good. We love that. Let's take a look at their balance sheet. So they have 365 billion in asset and something like 200 billion in liabilities. Let's take a look at their cash. So they have 100 billion in cash and 200 billion in liabilities. They can pay half of their liabilities only using their cash. That's awesome. They have 78 billion in debt, and they have more cash than that. It doesn't get better than that. Let's take a look at their intangible assets. So their intangible assets is something like 78 billion, which is 20% of their assets. That's very good. So they have all the patents and everything that creates them money, but it's not all their assets. So that is really good. They have a lot of property, plants, and equipments, probably because of their cloud business. So they have a strong balance. This is really good. Their income and their cash flow is growing very fast, which is really good. They have a great moat. Whatever services they have, their cloud, their office software, it's very hard if you are a user of Microsoft to change to another service. So they have a great moat. So we are going to keep Microsoft on our watch list too. And later on, we will do more research to see if it's a good price too. Because with these big companies, yes, they are all great. They have great moats. That's why they got this big. But is the price overpriced too? That's the next question we need to answer. We won't go and just buy them because they are great and they have a big moat. We need to not overpay for them. The next company on the list was Meta Platform. They have changed their name from Facebook to Meta recently. Probably you have used their services too. So they are the owner of Facebook, Instagram, WhatsApp, which they call family of apps. If we go to their financials and revenue breakdown, we can see almost all of their revenue is from family of apps. So they do lots of advertisement on Instagram and Facebook. So all those advertisement revenue goes to family of apps, and they have a little bit of reality lab. This is their revenue coming from the research they are doing around metaverse. This is a very small part of their business and it's not profitable right now. So they are making money from advertisement and then spending on the metaverse, which no one knows if it's going to be profitable in the future. But they are investing on this very heavily. And we need to wait at least 8 years to know if it will pay off. But let's go back and take a look at their share price. So from middle of 2021 and 2022, Meta price went down from around 400 to 90. It went down more than 80%, 85%. So probably many of our super investors saw this as a great opportunity to buy Meta around 100, and right now it's at 250. So this is something that happens. So whenever super investors try to buy a company, because they will invest lots of money on this company, it will cause the price to go up. So we shouldn't think of it like they predicted this going up. It's like they caused the price to go up because they bought it. So Meta has a big moat too. They have something like 3 billion active users, but the worries around them spending lots of money on metaverse caused the price to go as low as $90. But in the past year, Mark Zuckerberg has started to change course a little bit and be mindful of the shareholders' worries about spending that much money on metaverse that no one knows if it will pan out. So it seems that super investors like that approach, and they started buying, and that caused the price to go up. But let's take a look at Meta's financials. So we will start from the income statement, and we can see their revenue has gone up 5 times during the past 6 years, which is very good. Their operation margin is around 30%, which is really, really good. We love that. And they have been making 23 billion net income. Let's take a look at their share buyback. So they have been buying back shares, something like 10% of their shares they have bought back in the past 6 years. It's not very high because they recently started. So from 2.92, it didn't go down in the first 2 years. It went down a little bit in the third year. But in 2022, they have bought back a lot of shares. And that makes sense because the price was very low. So management thought it's a great price to buy back shares. That's something I love. Let's go and take a look at their cash flow. So cash from operating activities went up something like more than 3 times, which is really good. It went down a little bit last year, which is probably because of their recession worries. Many companies stopped doing advertisement. So advertisement budget is the first thing companies cut whenever they have worries about future. So probably that's why their revenue went down. But let's take a look if they have invested a lot. So as you can see, this is the part that caused the price of Meta to go down. So they have been investing a lot of money in their own business lately, and that was investment into metaverse. So this is the part that caused the price to go down 85%. But they have changed course lately. So as you can see, previously it was something like 9 billion. Now it went down a little to 6 billion. So in 2021 third quarter they spent 4 billion, but in 2022 9.3, which is more than 2 times. And in quarter 4 the same thing, almost 2 times. But in quarter 1 they didn't go that high, so they changed course a little bit, and that's why the super investor probably liked the management of the company. They pivoted. So let's take a look at financing. So they have been buying back shares in the past 2 years. Let's take a look at it annually. So in the past 2 years, 21 and 22, they have spent a lot of money buying back their own shares, which if the price is right, I love to see. And Meta price was very, very low during these 2 years. So I love to see that. They don't pay a dividend, so that's not a problem. And their free cash flow have gone down a lot. And that's because operating cash flow went down a little bit and their capital expenditure went up by a high margin. So that's why this went down a lot. But hopefully in the next couple of years, it's going to go up again, because we can see here it went down from 17 to 15 and then it went back up. So hopefully this went down from 40 to 20 and next year it's going to go up again. Maybe not next year, but yeah, in the upcoming years. So Meta seems like a great company too. We are going to keep it in our watch list for now and do a deeper dive into it later on. Let's move on to the next company, which is Alphabet. We know it by the other name Google, and probably every one of us know Google. They are the dominant search engine in the world. Most of their income is from advertisement too, so we can later on take a look at their revenue. But right now, let's take a look at the price chart. So in 2022, it has gone down from 140 to less than 90, which is why probably the super investors started buying it and they caused the price surge. But still, this company has a great moat. They have a great cloud service. They have the big chunk of the advertisement revenue in the world. So let's take a look at their financials. First, let's start with revenue. So most of their revenue comes from Google services, which is Google search and these sort of things that people advertise on, and YouTube. And they have a little bit, something like 10% of their revenue from Google Cloud, but it has been growing very fast. So it has gone up from 30 billion to 26 billion in just 2 years. So it's growing very fast. So let's take a look at their income statement. Their revenue has gone up from 90 billion to 280 billion, which is really, really great. So something like more than 3 times. And their operating margin is around 25%, which is very, very good. So let's take a look at their income is around something like 60 billion. So their income has gone down to probably the same reason as Meta. So let's take a look at their share outstanding. Their share outstanding has been going down steadily too, which is good. Maybe not as fast as other companies like Microsoft, but it has been going down, which is really good. So let's take a look at their balance sheet. They have 370 billion in asset and 108 billion in liabilities. Let's take a look at their cash. So their cash is 115 billion, which is more than their liabilities. So they can just pay all their liabilities using their cash, which is great. We love this kind of strong balance sheet. They have less than 30 billion in debt and 3 times that as cash, which is really great. So they are sitting on a big pile of cash and probably they will use it to buy other businesses, reinvest in their business, buy back their shares. They have lots of property, plant and equipment too, just like Microsoft. They are in the cloud business, so they need to have all these servers and equipment, so that makes sense. And they don't have that much intangible assets. That is really good. Let's go to their cash flow statement. So they have an operating cash flow of 91 billion, and let's see how much of it they need to reinvest it into the business. So something like 10. That's good. We love it to be something like 20%, but they are trying to reinvest a lot into their cloud business, which is understandable. It's growing really, really fast, and they need to compete with Microsoft and Amazon. So they they need to move fast and reinvest a lot of money. So let's take a look at their share buyback. Yeah, in the recent years, past 3 years, it has gone a lot higher than before, which is good. I believe they think that their company is undervalued, so the management start buying back their own shares. They don't pay any dividend. So they made 60 billion of free cash flow and spent all of it buying back their own shares. And that's understandable. Let's again take a look at their chart, and we can see in 2022 the share price has been going down and down, and management believe this is very undervalued for their company. So they started buying back shares, and we love that. So all in all, Alphabet seems like a great company too. We are gonna keep it on our watch list, check it out later on, and see if the price is good for us to buy too. And the next company is Amazon. So they have the biggest online store in the world. Their price has gone down a lot too. As you can see, it went back to pre-pandemic prices. So it went down to 84 from 107. So this caused the Superinvestors to think that this is a great opportunity to buy Amazon at a great price. So they have started buying, and now the price is 120. Let's go and take a look at this financials, and let's take a look at the revenue first, revenue breakdown. So their online store is something like almost half of their revenue. So these are the products that they sell on their website, and then they have 170 billion third-party seller services. So these are the other stores that sell something on Amazon, and they have their AWS service, which is growing very fast. You can see in the past couple of years it has gone up something like 7 times, which is great. It's moving up very fast. So all part of their businesses is growing very fast. Their subscription service has gone up 6 times. So this is a very fast growing company. It's a big company, but it's growing very, very fast. And we can see that in their cash flow. So one of the reasons that Amazon stock started going down is the fact that their operating cash flow was going up. It went down in 21 and 22. That's probably because 2020 was a special year. They went up by 71%. So going down was a little bit expected. If you compare 2019 to 2021, they went up. So this we shouldn't care about. They went very high up and then they went a little bit down. That's expected. But the main problem why the price went down is how much they're reinvesting into their business. So in 2020, they made 66 billion in cash, invested 40 billion of it. They made less cash in 2021 and 2022, but they didn't stop reinvesting back into their business. So this is the thing that caused the stock price to go down. Their free cash flow is negative right now. So this made some people worry that they are reinvesting a lot of money into their businesses. So will they be able to grow their free cash flow later on? Again, that's something we need to wait and see. But this is something that worries me too. They are growing really fast, reinvesting a lot of money into their business, but can they make more money by these reinvestments? That's something we need to do more research on. So let's take a look at their balance sheet. They have 462 billion in asset and 316 billion in liabilities. So how much cash do they have? 70 billion in cash, and they have 155 billion in debt. So they have been growing their debt more than 7 times. That's a little bit worrisome. So they can pay half of their debt using their cash, but it leaves them with 84 billion in net debt with a negative cash flow. That's going to be hard to pay off. So this is the part that we need to do more research. Are they making smart decisions with these reinvestments, or is it dangerous and they can't make that much money from these reinvestments and they are going to get into trouble paying back their debt? That's something we need to research more on. But this company has a great moat. So for now, we are going to keep it on our watch list and do more research on it. Thank you for watching this video. If you enjoyed, please like and share it with your friends. Subscribe to the channel. Hit the bell button to get notifications whenever I post a video and never miss it. Have a great rest of the day and see you on the next one.